A clear understanding the MACD, part 2, moving average divergence. Clear understanding MACD, part 2, moving average divergence. Good morning, good afternoon, good evening, bonjour, bonsoir, mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW 24 traders. And our website is www.stochastic-macd.com. The title of this video, once again, is A Clear Understanding MACD Part 2, Moving Average Divergence. In this tutorial, I want to clarify with traders once and for all what is a moving average divergence, okay, and what one should pay attention to when one is trading moving average divergence. As I explained to traders in the first part of this series of video that we call Clear Understanding MACD, a moving average divergence is different from the price divergence. A moving average divergence means a separation from another moving average. As I will show you in this tutorial, it will become clear to you that the price divergence is completely different from the moving average divergence. The moving average divergence is highlighting the strength of a trend. We want to understand that, and we want to take advantage of it. So when we see two moving averages separating, one moving average that is separating from another moving average, is confirming to us that a trend, either a short-term trend, a medium-term trend, or a long-term trend, is becoming strong. But when we are talking about trending phase, traders sometimes get confused, okay? Because if I'm on a 5-minute time frame, this is a short-term trend. So if I'm on a 5-minute time frame and I see a moving average divergence, it's telling me that the trend on that particular time frame is strong. Now the next question, how about the medium-term trend? If I'm on a medium-term trend, if I'm on a medium time frame, and I see a separation or a divergence of moving average, I will say that the trend on that medium term is becoming strong. The same thing is true when we are on the long-term trend. That's why you see traders use different moving average. Traders may place moving average 20, 50, 100, 200 on their chart. Now, but very often traders do not know how to interpret those moving average. They are just looking at them and they get confused or they get whipsawed. But the role of the moving averages is to confirm to us a trending phase and not a trending phase or a consolidation phase. Therefore, we use moving average divergence instead of the price divergence. So once again, I want to say to traders, a moving average divergence is when a moving average is separating, is parting from another moving. The angle between, okay, that moving average in comparison to another moving average is getting wider and wider. You see, the angle, okay, the space between two moving. So when we are talking about the divergence of the moving average 12 in relation to the moving average 26, this is about the standard MACD. We can compare the moving average 12 to the moving average 50. So here it is, the black line and the orange line. This is the moving average 50, the orange line, and the black lines. So we can compare the angle between the two. Now, then we can do a lot of things with the moving average divergence. So when we can use the moving average 26 and moving average 12 to pay attention to what? The short-term trend. Here it is. So when we see that, we know that the short-term trend is becoming stronger. If the angle, there's a divergence, if there is a moving average 12 divergence, you know what I mean? Moving average 12 divergence is the separation of moving average 12 from another moving average. In this case, separation from the moving average 26, because we are talking about the standard MACD 12, 26, 9. So when I'm on this daily chart and I see that, I say that, okay, currently on this daily chart, okay, the short-term trend is what? Becoming strong at this point in time. So because the price is breaking resistance, what should I do? I'll give priority to bullish signal during that time. This is about the separation or the divergence of moving average. One can also use other moving average. Here we can compare the moving average 26 to the moving average 50. Because I'm on a daily chart, I'm trying to look ahead into the future, okay? I want to see the bigger picture. I will switch my attention from comparing the moving average 12 to the 26 to the comparison between the moving average 26 and 50. So this is telling me that, okay, George, on a medium-term time frame, the trend is also strong in this point in time, a separation between 26 and 50. We can play with this, try to interpret that. But there is a better way to do that, which I will explain to traders in part 4. It makes sense? So for the purpose of this verification, the purpose of this video that we call Clear Understanding MACD Part 2, Moving Average Divergence, I'm going to switch my time frame from the daily chart to the weekly chart. This method, the moving average divergence, is a market stable data that is true on every time frame. So you see now, my friend, if you want to build a trading strategy or we want to build a valid trading system, we must build a system on market stable data. Now, I've seen it 100 times when one is building, okay, a trading system or a trading strategy based on useless facts which are not, okay, solid. So here it is. The divergence of moving average is a market stable data. So one can build a valid trading system based on the moving average divergence. So here we are. We are on a weekly chart. So on a daily chart, that information was true. Here it is. Let's compare now the separation between the moving average 12 and the 26 on the weekly chart. If it's market stable data, it will be true on every time frame. If it's useless, okay, or crazy, okay, facts, it won't stand on many grounds. But if it's a solid truth, it will stand on every ground almost. Here it is. We see a separation between the moving average 12 and the 26. We see a divergence of the moving average 12 from the moving average 26. What is it telling us? So you can see there was a consolidation first. You see there was a consolidation. Now the angle is becoming wider and wider. It's telling me that John forget about consolidation at this point in time. A trend is beginning. Now, if a trend is beginning, if the trend is in place, what should we see? Now, there's another tool that we use, talking about moving average divergence. We can combine it with another market stable data, the rising channel, the market pattern. So we want to have the market pattern in place with the moving average divergence, and we want to give priority to bullish signal, okay, if we are in a rising channel, and give priority to bearish signal, okay, if we are in a declining channel during the moving average divergence period. Here it is, a separation between the moving average 12 and the moving average 26. One can also compare the moving average 12 and the moving average, okay, 50. But here we want to see what is happening now. So 12 and 26 will tell us now what is happening now. All right. So if a change is taking place, we will see it by comparison of 12 and 26. Now, if you want to see the bigger picture, we'll compare, for instance, 26 and 50. The bigger picture is solid, wider, but what's happening in the short-term trend? If the long-term trend or the medium trend is bullish and the short-term trend is becoming bullish, we will buy. All right? Short-term trend, medium trend, top-down trading method, moving average divergence, or moving average separation. This is true also. That's why we say MACD, the ultimate role of MACD is to pinpoint trending and no trending financial securities with the moving average convergence divergence. Here we are talking about moving average divergence, which is a separation of one moving average in comparison to another moving average. Talking about the standard MACD, we are talking about the separation of the moving average 12 from the moving average 26, or the separation of MACD from the equilibrium line or the zero line. So do we need the ADS to tell us that a trend is in place? Another thing I want to clarify with traders. So, you know, some people understand that there is nothing from nothing. There is always a cause. So what I want traders to do, to go to play a little bit of mind game, all right? So ask yourself, whenever you see a moving average separation or a moving average divergence, ask yourself, what has caused the moving average divergence? With that question, you will start making better decisions because you're going to the roots. That's why we say to traders, the trading setup or the origin of a valid trading signal is from valid, okay, trading setup. So by asking what has caused that signal, what has caused the moving average separation, moving average divergence, one will now filter out useless moving average divergence and best moving average divergence. Now, the reason why I'm saying this now is that trader will learn this for the first time and they will apply and they will get quickly into trouble. They will say, Joe, this is useless, and they will mark the video down. But the point I want to say to you, a market stable data is never useless because if it's true on all time frame, it's valid. Now, let's go now to the monthly chart. So we did it on a daily chart, we see on a weekly chart. Let's go now to the monthly chart with the standard game. Here again, you can see that there the angle between the moving average 26 and 12, there is a divergence of moving average 12 in comparison to the moving average 26. Once again, the angle is wide, okay? Here you see it's very close. This is what we call convergence. Here it's very close, okay? Now when we see the separation in place or a divergence of moving average 12, is alerting us that right now there is a trend in place. Well, ask the best question, what has caused the divergence? I can tell you now, here for this one here, what has caused that divergence is a valid support level. This one, a double bottom pattern was in place, a valid support was in place. Now we see a trend that is taking place. There are more to this we can talk about. That's why when they look at the TSCW24, they say, I am mad, but I'm never mad. Okay, let's move on from that topic. So again, we are on the monthly chart, and the separation is still true, and we can verify with the market pattern and other market stable data that yes, there is a trend in place. If there is a trend in place, we will have a rising channel or a declining channel. Yes, there was a trend in place. The separation is true. Powerful information about MACD, talking about moving average divergence. I hope you are having a clear understanding of MACD. Maybe you are a critic of MACD. Now you are loving MACD. Yet again, we are talking about separation. Trend is in place, which we have seen already on the monthly chart. No big difference. All right. We can go on and on. If we see a separation, like you see here, we are now on the monthly chart. We see here on the market, you see it's a big separation between this. One thing traders should pay attention to. All right. So we are talking sometime about multi-talented trading. So traders learn something new for the first time. They want to use it. Okay. As they are using it, they forget about everything else that they have learned before. Don't do that. So when you are using the moving average separation or moving average divergence, don't forget the key support and resistance level. I will stop here, otherwise the video will be too long. If you like this video, please give us the thumbs up. If you dislike it, please give us the thumbs down. If you love it, feel free to share it on Google+, on Twitter, and also on Facebook. If you love our videos, feel free to subscribe to our channel because more tutorials like this are coming soon. This is about clear understanding, MACD Part 2, moving average divergence. To summarize this video, a moving average divergence is a separation of a moving average from another moving average. It has nothing to do with the price divergence itself. It's alerting that a financial instrument, a stock, a commodity, or a currency pair is trending. One must now ask the correct question. What has caused, okay, the divergence? One must always combine the technical analysis and the fundamental using market stable data, moving average divergence, market pattern in order to make a better trading decisions. I invite you now to follow me in the next video where we will be talking about clear understanding MACD Part 3, moving average, okay, convergence. See you there, be square. Speak to you soon.